if you have a capitalistic society, what you're going to have is that companies, when their prices go up, they're going to say, okay, well, as long as people will still buy it, we're going to raise our price. And this way our profit margins remain the same. Now, what she's saying is that, hey, listen, they should be saying, okay, we're in a very tough spot. Consumers are hurting. So maybe we'll take a cut on the amount of money that we're profiting. And therefore inflation doesn't have as big of a bite. So again, I mean, this is the big battle, right? I mean, which one do you go? Do you go with one side or the other side? My always feeling about it is that there should be some happy medium. And I think most Americans would agree is that, you don't have to be hard-nosed and say, screw everyone on this side. And you don't have to be on this side and say, oh, we're gonna totally, wreck the profits of these companies. There's some sort of the Fed has been amazing at just telling the market and reiterating again what they're gonna do. So we're going to get a 50 basis point hike. The key is going to be this, right? And this is what the market's looking at. And by the way, we're getting a pause day today in the markets. You'll probably get that again tomorrow because everyone's just waiting for this. And the statement is what's going to make the difference. So what I've been saying to people is from a 1 to 10, the Fed has been talking up the rate hikes and what they're going to do at a 10. They're at the most hawkish that they've been in a long time, if ever. But I think the worst case for the market would be if the Fed came out at a 10, meaning just as hawkish, as amazingly harsh and hawkish as they've been. And they basically said, hey, listen, no matter what the economy does, no matter what the stock market does, we are going to continue to rip rates higher 8 times this year or so. That would freak the markets out because again, what the market's concerned about here is that the Fed is slowing the economy. The supply side of things is causing price inflation, which is slowing the economy. Oil prices are high, that's slowing the economy. And the market wants to know that if the economy slows substantially, the Fed will back off a little bit. So if the Fed does not say anything like that, that will scare the markets. If the Fed gives us just that inkling, that little tiny crack in the wall that says, hey, listen, we would potentially back off from 8 rate hikes to 4 or 6 or 5, that would be something that the market would say, all right, the Fed is still around. They're still here to help us just in case. Yes, they have to fight inflation, which is important, but they're not totally leaving us for good. The 10-year is bubbling up against 3% today. I do think you are going to get a pullback off this 3% level. In fact, I've been buying the TLT, which is kind of an inverse play where if rates come back down a little bit in a short-term trade, and this is only a swing trade, TLT would bounce. So I've been accumulating the TLT. We've seen Facebook collapse. We've seen Netflix collapse. Apple's still holding on, but notice how Apple's earnings were amazing and the stock is still selling off. Notice how Tesla's earnings were amazing and Tesla still ended up selling off after that initial pop on earnings. Those are the signs that tell you big money is exiting from these big names, and it's just the start. And because those names make up such massive percentages of the indexes, that alone can take down the markets. I mean, you could have some of these beaten down plays that are down 90%, hold steady even, probably go down a little, but just those big cap names can take the NASDAQ 100 down another 20%. So the Federal Reserve went from a body that was printing. The government was printing. And all of a sudden, we're not getting any new stimulus, no new kind of build back better plans in the government. That's not going to pass. And the Federal Reserve reducing their balance sheet, raising interest rates, stopping QE. And it's basically putting a hard ceiling on the market. The market has no place to go but down to kind of unwind what we've been seeing. So this is kind of why in December when I talked about how gold would be the best performer in 2022. And so far it has been as we approach getting closer to the midpoint in the year. But bottom line is this market will have major bounces. The great thing about a market that's not backstopped by the Fed is that there's volatility. So for swing traders and day traders, this is the best market in the world. For investors who are long-term, it's going to be a tough market. There's a lot more downside to go. And the bottom line is, I've been warning people to be more cautious, to be more conservative, be more of a trader if you're a trader, otherwise sit on the sidelines or get into something like gold. And I think that's important to understand, folks, is that people always said, don't fight the Fed on the way up, right? Because the Fed was printing money. Yet for some reason, people are fighting the Fed now when they're doing the opposite and they shouldn't be. So think about that. It's very, very logical. Don't use emotion. You're seeing stocks that are discounted heavily. They're going to get cheaper. Apple's going to go down. Amazon probably goes to 2,000 before it gets a level to buy. So be ready for that. The Fed and the government are absolutely responsible for inflation. I mean, you cannot just print trillions and trillions and expand a balance sheet and pump this much money and basically rescue a market. And that's really what happens is that Fed. The Fed throughout time has always been the backstop. So if the markets were to fall, they always cushion it. And what does this do? It makes people want to borrow more money and put it in assets, because assets just always go up. There's never any repercussion. There's never any downside. Heck, we saw in 2009, some banks were bailed out and they should have failed and there was no repercussions. And then now they're doing the same sort of lending stuff again. Yeah. So again, bottom line is, this is all stems from monetary policy and government overreach in terms of spending. And listen, I'm all for doing certain types of spending where you help people, but it's gotten to the point where there's way too much kind of fluff in every single deal, and you got to cut it out and go right to the source. So again, this is where Bitcoin comes in, and the future of why I believe in Bitcoin, even though I'm a near-term bear, meaning that I think it's going to go lower. But yeah, I mean, it's absolutely the Federal Reserve that's at the core of this. And bottom line is, the charts are telling me that both natural gas and oil are going to go lower. So that's telling again, and charts are very important, because what it tells you is that, when you're seeing these headlines and oil's not making a higher high, or natural gas, for instance, we heard about, Russia maybe cutting off the pipelines of natural gas to Poland and some other countries. And the bottom line is, the oil charts and the natural gas charts didn't even make higher highs in the near term. Here's your high on oil, lower high, and basically lower high. That is not a bullish sign. It shows you smart money is moving away. Now, if we look at the natural gas chart here, the same thing is going on, right? So basically, you got those headlines, and look at how this high, which was about 2 to 3 weeks ago, even with the headlines recently about natural gas, you're not seeing natural gas make a new high. Now, part of that probably is that we're warming up. The world, again, Europe is starting to warm up. But again, when you see lower highs on more aggressive headlines where the price should actually be making a higher high, that's telling you smart money is starting to unload. And the bottom line is, the reason why I don't believe that oil and natural gas are going to make higher highs is because now the global economy, and people are starting to realize this, the global economy is starting to slow due to high oil, due to high inflation, due to Federal Reserve and global central banks hiking rates. And that again is going to hurt the demand side, which will keep prices from making new highs. Well, and just selling their bonds. So I mean, they're getting, as the bonds are rolling off, they're rolling off their balance sheet. I mean, that is a way to tighten monetary supply without raising interest rates. So there are ways to do it. The Fed now is caught between a rock and a hard place, which is in their own doing, which is they've created this scenario where you have massive inflation, and then you have these kind of effects like these black swans where Russia invades or China is now shutting down these cities, and it causes more of an inflationary pressure. But the pressure was already there because of what the Federal Reserve was doing, and it's inevitable that you're going to have these black swan events that at some point are going to bubble up, and it wouldn't be as big of a deal if you didn't have all the monetary easing that caused the initial inflation surge.
Subscribe to keep learning the truth.